Okay, so accounting 201 is financial accounting. So what we're aimed at doing is the end product is to come up with things we call financial statements. And these financial statements are for people that are interested in what's happening in the company, but they're not necessarily part of the company, right? So if you're gonna be if you wanna buy stock in a company, you're probably gonna wanna look at that company's financial statements. Okay. If you're somebody lending money to the company, you're going to want to look at that company's financial statements. Okay, so there's 4 main financial statements, and when you prepare them, right? Because we're the accountants, so what we end up doing is we end up preparing the financial statements. We're the ones that put the data together to have these financial statements. Okay? And they're done in this order that I give them to you. So you're going to have income statement. You're going to have what they call the statement of retained earnings. Okay, and you got the balance sheet, and then you got what we call a statement of cash flow, or cash flows. Okay, so those are the 4, and they're done in that order. So we're starting with a bird's eye view, and then what we do in this class is we work down into the detail. Okay, so there's a bunch of stuff that goes into each of these statements, and there's a bunch of ways to record transactions. As part of what we're doing is we're going to be recording transactions that the company engages in throughout an accounting period, and then we're going to compile that and come up with numbers that go into each of these statements. Okay, so maybe I can break it down a little bit. We can start with income statement. So we'll slide these down for now. And the 2 main things that go into the income statement are revenue and expenses. Okay. Did anyone start reading or like looking at anything? I'm just gonna rely on me, okay? All right. Revenue is what we earn, okay? So you can say amount. That's going to be a formula if I do that. Amount earned from services provided or goods sold. Okay. So just with that like brief definition, can anyone give me an example of what revenue would be? You can come up with your own type of company, like be creative with it and think of what revenue would be.
Service, hospitality services.
There you go.
Yeah.
That would be revenue.
Consulting services.
Consulting services. Like so if I did some consulting for another company and I sent them a bill for maybe I'm charging $500 an hour, right? And I sent them a bill for 10 hours, then I sent them a $5,000 bill. That's the revenue. Okay. That's without subtracting anything for what it costs me to generate that revenue. Okay. So just with that definition, you can kind of come up with a definition for expenses, right?
The amount that costs for you to provide that.
Yes, so it's the cost of, basically in a nutshell, providing goods or services to a customer. So that's what goes into the income statement. So what you're going to do on an income statement, basically you're going to take, right, your net income will equal your revenue minus your expenses. Okay? That gives you net income. Now what if your expenses are more than your revenue? Well, you know, it's real nice and simple if my revenue is more than my expenses, right? Say I'm in the used stereo business, and sometimes I get the stereos for free because somebody just wants to get rid of it. You know, I pick this stereo up for $10, and I turn around, I clean it up, and I sell it for $100. So that's nice, right? Because right, I got a $90 profit. Right, $90 in net income, if you want to call it that, because it's $100 revenue $10 expense.
Mhm.
Okay. But what if I'm in a situation where it's a little tighter and actually my expenses end up being more than my revenue? What do I call that?
Net loss.
Net loss, right? It's still going to be on the income statement, but it's going to be called a net loss. Okay. So it's important that you get that idea that revenue is what we earn for the goods or services that we provide, and expenses are the cost of providing those goods and services. Okay. Does anyone have discussion on that? Clarification? You could. Now the thing is, revenue doesn't have to be received in cash. Right? Say I have a yard service business and I bill people. Right? So I could go out and I could have done the work, so I've delivered the services, but I might not get my cash for another 15, 30 days. So I'm waiting to collect it. Okay? Does that make sense? But I still have to record the revenue when I've delivered the goods or services. That's what makes this class accrual-based accounting. Revenue is recorded when it is earned. Okay? So not necessarily, not when paid. So you've earned the revenue when you've provided the services or you've delivered the goods. Okay? Keep that in the back of your mind. Because there's instances where you could get paid up front, but you haven't provided the goods or services. So in that case, you wouldn't record revenue. You actually have an obligation. And we'll get to that later. I just try to give you some of the elements here. So income is synonymous with, I'll make another note, net income, that's a big fancy word, okay, means the same thing as earnings, okay. So what that tells me is, see, we keep track of income by accounting period. So 2018, 2019's income, 2020's income. See, we got these little time blocks that we're tracking income for. Now, if you've had income in 2016, 2017, right, you're starting to accumulate income or accumulate earnings. Okay, so that's what the statement of retained earnings tells you. That tells you how much of the earnings that you've had since the beginning of your company that you've held on to. Okay, because there's one way to pay out earnings, and that's in the form of a dividend. So anyone that has ownership in the company could, depending on what the board of directors determines, receive a dividend from the company. And the dividend comes out of retained earnings. It's not an expense. Okay? It's not on the income statement. So on the retained earnings statement, what we do is we start with the beginning, and I don't know if I'm going to spell beginning right. Should let me know, right? Beginning retained earnings, and then we're going to add the net income for that particular year. Okay, so the beginning retained earnings is all of the earnings that the company has held on to from the beginning of its existence. Okay, net income is the earnings for that particular period. So if we're looking at 2018, this would be 2018's net income. Okay, and this is actually the format of that statement that I'm giving you. Right, you would probably like have a little line there, and then what you'd have is a subtotal. Then what you would do is you would subtract. So when we use the word less, that means we're going to subtract. And that's where we would subtract the dividends. I'll make it capital. So any amount that's paid back to shareholders out of the earnings is called a dividend. How many have stock? How many have stock and they don't know they have stock? You'd be surprised, right? Maybe some of your parents got mutual funds for you. Well, there's stock in the mutual funds. Okay. Yeah, so anyway, dividend, and then when we subtract that, what do you think we end up with? I'm giving you a hint. You need more of a hint than that? Okay. You end up with your ending retained earnings. Okay. So you see, we can't figure out retained earnings, the ending retained earnings, until we figured out net income. That's why we have to make the income statement first. Then we make the retained earnings statement. Then we're going to make the balance sheet. Now, the balance sheet is a good place to talk about the basic accounting equation. So the basic accounting equation, is, okay, Tia got it. We go assets equal liabilities plus stockholder, or sometimes called owner's equity. Stockholders are owners. Equity. Okay. So we're going to have to talk about those three elements. Okay. Because what happens is students confuse revenue with assets. Okay. Or they confuse liabilities with expenses. They're totally different things. Okay. What is an asset? Does anyone know?
Your receivables, your cash on hand.
Those are specific assets, but like if we were to define an asset, would anyone be able to?
Something you own.
Something you own. That's the very basic. Okay. Anybody else got a?
Something you own that makes you money, right?
In a way, yeah. Something that you own. That's a good way to put it because
That
it's
makes you money or that is worth?
yeah, worth money. Yeah, it could make you money. It could be worth. I mean, the real technical definition would be something that the company owns, has title to, that has economic value or has future economic value. Okay, so in a way, when you think about economic value, that means that you could convert it into money, or in the future you could convert it into money. Okay, so that's what we're looking at. So, like a piece of equipment could be an asset. If this was a company, and you know, these are all assets for the college. All of these computers, the tables, the building, it's all assets. And the land under the building, it's all something of economic value that the entity or the company owns. Okay. So if you have that definition down in your mind, what's a liability?
Oh, to another company.
Yeah, something that's owed back to another company or to an individual, right? You know, how many have a job? Okay. It doesn't have to be a full-time job, but if you have a job and you get a paycheck, you realize that your paycheck is a little delayed from the last day that you've worked towards earning that. Okay? So what happens is, from a company standpoint, we have to accrue a payroll liability, right? Say you worked, your pay periods end at the end of the month, right? The 15th and the end of the month. So when December 31st comes along, right, and we have to make a balance sheet, we're going to have to show that we owe so much in wages, which we haven't paid yet, for December 31st. So that's an instance where we have a liability to an individual, right? People that are on the payroll. Because that paycheck probably won't come at latest until the 7th of January. Legally, they have till the 7th to pay it. Okay. What else could be a liability?
Services owed maybe?
Yeah, well, that's a unique one that we haven't really gotten into yet, but that's kind of back to what I said earlier. What if you get paid in advance for services? Like you're a lawyer and they pay you $10,000 up front, okay? And that's not necessarily a retainer, but they're paying you for work that they haven't done yet. Well, that law firm has a liability now. They have what they call unearned revenue. That's a liability, and they owe this work to you because you're going to use their services. So they have two things. They have cash. They've received an asset, cash, which is not revenue. It's just cash. They have cash now, $10,000, but they also have a $10,000 liability because they owe $10,000 in legal services to you. Okay, and that balances the equation. We're going to get more into this, but right, we always have to keep this equation in balance. So every transaction has an effect that keeps the equation in balance. Okay, it could be something happening on one side or something happening on both sides. So that's the basic accounting equation, and that's how the balance sheet is laid out. It's probably done vertically, or it's probably done one column with all your assets on the left and then your liabilities and equity on the right. But the total of the two will need to equal, otherwise something's not correct. Okay? Right. So how come I have to do retained earnings before I do balance sheet? Okay? Because you see this guy here, stockholders' equity? Let's see if we can. Stockholders' equity, make it underlined, right? Stockholders' equity is comprised of two things. And I'll put it here. In our course, we're going to probably say the two things are common stock and retained earnings. And it will need to be the ending retained earnings. So just keep that in mind. Stockholders' equity is made up of these two things here. Common stock and retained earnings. So you wouldn't be able to get the right retained earnings figure on your balance sheet until you figured out what the ending retained earnings are, because it's made up of ending retained earnings. If you were to use the beginning retained earnings when you make your balance sheet wouldn't balance. This equation wouldn't work out. Your assets wouldn't equal the combination of your liabilities and equity. Okay? I know it's a lot to take in, but hopefully the recording, I thought it was recording. Yeah, I think it's recording. And then you can go back and I'll put it in Laulima. Okay, and then the statement of cash flow, you need two balance sheets to do it. You need last year's balance sheet and you need this year's balance sheet. So that would be the reason why you have to do statement of cash flow last. And I'll just give you the sections, right? In the statement of cash flow, you're going to have cash flow from operating activities. You're going to have cash flow from investing activities, and cash flow from financing activities. Okay, and real quickly, can anyone tell me what an operating activity is? Okay, the way you classify an operating activity is you've got to think in your mind, okay, is this something that our business is about? Say we're in the business of selling water bottles, right? So all of the people on the payroll are probably aimed around selling these water bottles. So payroll expense would be an operating activity. Okay, the cash coming in from the sale of water bottles would be an operating activity. So it's really what your central business is about. That's your operating activity. An investing activity would be anything where we're sinking money back into the business. Maybe we have to buy new delivery trucks. So that would be investing in the business. Or maybe we're selling our old delivery trucks. So we're in the business of selling water bottles, not delivery trucks. So that's an investing activity. Okay? If you sell a delivery truck, you're going to have cash coming in. Okay? So you're going to have a cash inflow from an investing activity. And then finally, financing activities would be anything that you do where you borrow money to sink back into the business, or where you issue more ownership shares. So coming back to common stock, right? So you're raising money. You're not getting this money from your business activity, from your selling of water bottles. You're getting it from investors and lenders, or you're paying them back, right? So when you think about a statement of cash flow, you're going to think categorically operating, investing, financing, but you're also going to think flow, right? Is it money coming in or is it money going out? Okay. And we're not there yet. We're a long way from statement of cash flow. Okay. But we are right where we need to be with 1, 2, and 3. Okay, so your job is to get a handle on these terms. revenue, expenses, assets, liability, equity, common stock, retained earnings, and really get an understanding of that. Because what we're going to do next is we're going to start looking at transactions, and it's going to be kind of like, okay, what increases, what decreased, what do we have more of, what do we have less of, okay? So you can work ahead into that and start thinking about that. And then at some point, did I put the syllabus away? Right? At some point, and I know I got to put number 6 in here. Thank you for reminding me. Right? We are going to, probably next week, we're going to start talking about what we call debits and credits. Because those are the tools that we use to record these transactions. We're not going to just say plus and minus. We're going to say, okay, cash increased, I have to debit cash. And everybody's going to be like, well, debit cash, that means it decreased. Well, not for us. Because all assets increase with debits. And cash is something you own. So that's an asset. If you get more cash, you have to debit cash. If you spend cash, you have to credit cash. Okay? So work up to that point. So next Tuesday we can talk more about that. I'd like you to kind of get to that point. Go over your financial statements. Any questions? Concerns? No? Okay. And we'll try to work on the names again Tuesday. Thank you for coming. And you can email me, you can call me, come by if you want to. Let me see if I can stop this.